In this video clip, I'm going to look at the liquidation journal entries that needs to be recorded during the liquidation of a company. And for this, I'm going to use Extra Liquidation 2, one of the questions provided as part of the preparation for the final exam. Before I look at the actual journal entries recorded, I first want to review the general ledger accounts that's drawn up as part of the liquidation process. You can't really prepare the journal entries without reconstructing the ledger accounts, because a lot of the calculations and workings actually we get from the information in the general ledger accounts. Now you know by now that there are three main ledger accounts used as part of the liquidation process. It's the liquidation account, which is the account where we basically tie in all the loose ends of the liquidation process. As part of the liquidation process, we want to close off all the other general ledger accounts and see whether there's a deficit that needs to be borne by the shareholders, or whether there's a surplus on the liquidation that is then transferred to the shareholders' distribution and distributed to the shareholders. So in the liquidation account, we'll typically see that on the debit side, we close off the assets, the carrying amounts of the cost accounts of the assets in the company that's being liquidated. So these are the first few entries. And when we do that, we also need to close off the contra accounts to these assets. So any provisions for or allowances against those assets, for example, depreciation, or with the accounts payable if we have a provision for doubtful debts. Secondly, we then record the proceeds from realizing those assets. Now, that can include different components depending on whether we have secured creditors that took control of an asset and realized it to for their best at the best possible value to cover their debt, in which case the balance on that realization of the asset needs to be transferred to or returned to the liquidator for distribution in the liquidation process. But in general terms, on the credit side of this account, recording the proceeds from realizing any assets in the company being liquidated. The third category of entries in this account relates to any unrecorded liabilities. So what we basically do is any liabilities that still needs to be settled as part of the liquidation process, but which weren't raised as liabilities in the liquidated company's accounts, needs to be raised as part of the liquidation process. And instead of recording the expense, we record it to this liquidation almost control account or working account for the liquidation process. So the credit entry to that would be the liability that we create. In this question, I'll look at the details, but there's also been land and buildings that were part of security for a mortgage holder, so that is what's dealt, or this entry here. So I'll deal with that as we go through the actual question. Lastly, we then transfer any reserves to the liquidation account. Reserves with a credit balance is going to increase any surplus that is transferred to the shareholders, or if there's a deficit, as in this case, it's going to reduce the deficit borne by the shareholders. The company had accumulated losses, so therefore we see that retained earnings has a debit balance for this company that's being liquidated, so therefore that actually increases the deficit of the shareholders. So we're going to credit retained earnings, debit the liquidation account. So with that step of the liquidation process, all reserves and other equity balances except the share capital is transferred to the liquidation working account, general ledger account. The one item that's not transferred to the liquidation relates to the cash in the liquidated company. We've got a separate ledger account to deal with the cash resulting from the liquidation process. So what we'll first of all see is that any cash that sits in the company that's being liquidated will be transferred to this liquidator's cash account. So this account basically just records all the transactions relating to proceeds from the realization of assets, so cash that is received as well as any cash that is distributed. Now in this question, the company actually didn't have any cash, but they had an overdraft, so that overdraft needs to be settled, so it actually weakens the cash position of this company. So therefore we see that it's lying here on the credit side. So it would have been debit the bank overdraft, which sat with a credit balance, and then credit the liquidator's cash. Okay, so the first step regarding the liquidator's cash would be to transfer any cash balances or overdrafts. Of course, the cash would have been an adjustment to debit to the debit side. The other entries in this account relates to the proceeds from realizing the assets. So you'll remember that from the liquidation account, where we had a credit entry to record the proceeds from the realization of the assets, and then the cash that we've realized is recorded on the debit side of this account. The next step is then to settle the creditors. This, of course, is done in terms of the ranking of the creditors. First of all, we would have considered any creditors, secured creditors with a fixed charge. They would have been settled before we pay any further creditors. We then cover the secured creditors with a floating charge, but if the company is in a position where they don't have sufficient funds to pay all the contributors to the company, remember that section about the employees then having a preferential claim. Okay, so they would have been paid first before we paid the creditors with the floating charge, for example, the debenture holders. Then it's your unsecured creditors. The liquidation expenses, actually, it's the first creditor that will be paid. Okay, and our accounts payable. Sorry, that is our unsecured. I'm sure that accrued expenses properly relate to the employees. I'll just look at the question when we get to the actual details. Okay, so in this example, we also had a deficit on the liquidation process. Now, the shareholders are accountable to the company for the deficit in the process of liquidation if their share capital is not fully paid up. So they only have a liability up to the issue price of the shares. So in this example, the shareholders didn't have fully paid up shares, so the company wasn't, or the liquidator was in a position to make a call on ordinary shares sufficient to actually cover the cash shortfall for the liquidation process. The last entry then is, and with this we actually close off all the accounts in the general ledger, is where the paid up capital is transferred from the share capital account to the shareholders distribution account. This is the third ledger account that we use in the liquidation process, and we can record the distribution to the shareholders in this account. Okay, so we start off by transferring the share capital. Share capital, of course, sitting with a credit balance, so we debit our share capital and credit our shareholders distribution to transfer the share capital to this account. And then, depending on the final result of the liquidation, we'll then see that either the surplus that exists is distributed to the shareholders, in which case it would be a debit entry to this account for bank, or in this case we've now made a call on the portion of the share capital that wasn't fully paid up, that was sufficient to cover the cash shortfall, so there's no distribution to the shareholders, and the deficit from that was still sitting in the liquidation account is then transferred to the shareholders distribution. As you can see, the capital then covers the deficit, and there's no further distribution made to the shareholders.